This is Optimal Finance Daily, episode 777, an early warning system for your investment portfolio by Darrow Kirkpatrick of CanIRetireYet.com. And I am Dan, I'm your host here on the show, here each weekday reading to you from some of the best personal finance blogs on the planet. And before we get to our post from Darrow, if you've been listening for a while, you probably already know that we give away books to random people on our mailing list. And we do that each and every month. So if you'd like a chance to win, make sure you join. Sign up for that mailing list. It is totally free. Just enter your email address at oldpodcast.com. For now, let's get right to our post as we start optimizing your life. An early warning system for your investment portfolio by Darrow Kirkpatrick of CanIRetireYet.com. It's every investor's worst nightmare. You check your portfolio one morning and find it's worth much less than you thought, or has lagged the market significantly. In my experience, that usually happens due to a lack of diversification. Imbalances of different kinds can sneak up on even the most experienced investor. I'd categorize my most significant investing mistakes as errors in diversification. Wouldn't it be nice to have a simple system in place that could tell you if you're veering off track? Well, I don't know of a completely automatic and foolproof system other than perhaps investing your entire portfolio in a target date fund. But the measures I'm about to describe can go a long way toward keeping you out of trouble. Diversification is one of the handful of core investing principles, but how do we measure or quantify it? There are more academic approaches, but for everyday management, I like a simple collection of percentages, measuring what portion of a portfolio is invested along certain key dimensions. Together, these metrics can form an early warning system for your portfolio, alerting you if you're becoming dangerously concentrated in any one area. Just like warning lights at sea or on a car's dashboard, they will alert you if your portfolio needs attention. Each of these diversification metrics takes the form of some quantity as a percent of your stock holdings, all stocks, or of your portfolio, all investments, or of your total net worth, all investments plus personal property. Here are the measures I've found most useful. 1. Percentage of stocks in your portfolio. The allocation between stocks and bonds may be the most important distinction in your portfolio. This division will have a fundamental impact on your expected long-term returns and volatility. Keep this number in prominent view at all times. 2. Percentage of individual securities in your portfolio. For each individual security you own, you should know what percent it represents of your total portfolio. Extremely small positions may not be worth your time. Even if one does spectacularly well, you haven't put in enough money to have a significant impact on your overall return in most cases. Extremely large positions, on the other hand, represent risk unless they are well diversified. 3. The percentage of your stocks that are growth versus value. Growth and value separate stocks in the investing universe based on book values or earnings. If you invest in the entire market, then of your stocks, 50% would be growth and 50% value. Many studies have found that value stocks have higher returns over the long haul. Overweighting them may give you better long-term performance, yet they are cyclical, so that can also cause your portfolio to underperform for long periods. 4. Percentage of each asset class in your portfolio. There are two significant asset classes beyond stocks and bonds that I recommend investigating once you move beyond entry-level investing: real estate and commodities. But both can be volatile and cyclical. If and when you do invest, watch your allocations carefully. 5. The percentage of your portfolio that is actively managed. Few active fund managers are able to beat their associated index. However, some of us may have actively managed funds in our portfolio anyway. Perhaps we bought them long ago or received them as gifts or as an inheritance, or perhaps we are simply hedging our bets on index investing. At any rate, given the costs versus benefits of active management for most asset classes, I would recommend ensuring that the bulk of your portfolio is in low-cost passive index funds. 6. Non-dollar as a percentage of your net worth. Just as you would not put all your investments in the stock of a single company, you should not have all your assets in a single country. Long-term demographic and economic trends do not favor the U.S. Any number of unpredictable short-term events could hurt the dollar, so it's advisable to have a meaningful portion of your net worth in assets that are not tied to the health of the U.S. or the dollar. 7. Government-related investments as a percentage of net worth. Though long-term trends may not seem to favor the U.S., don't count us out. Legendary investor Warren Buffett continues to feel that the U.S. has the best economic and political system in the world, and any number of short-term events, from global depression to European defaults to wars or disaster overseas, could send the world packing into the historical safe havens of the past century, the U.S. dollar and Treasury bonds. Hence, it is wise to have a meaningful portion of your portfolio in safe, familiar U.S. bonds, treasuries, or other government obligations. And 8, the percentage of your net worth that is inflation protected. Inflation is the termite of the financial world, silently eating away at your nest egg until one day there is much less floor underneath you than you thought. Inflation is the primary risk factor in investing too conservatively, so it's wise to track which assets in your net worth carry some degree of inflation protection. For starters, you should include any inflation-protected bonds or commodities that you own, as well as real estate, and even some stocks in this number. All of these have been historically resistant to inflation. So those are some of my favorite simple indicators for managing risk in an investment portfolio. For more detail on exactly how to compute these quantities, what to include and what to exclude, stay tuned here for more on the topic. You just listened to the post titled An Early Warning System for Your Investment Portfolio by Darrow Kirkpatrick of CanIRetireYet.com. And once again, if you want to have a chance to win some free books from us, make sure that you are on our mailing list. And to do that, you simply have to visit oldpodcast.com. You'll also get some free financial spreadsheets from us, including one that shows when you can retire, a video tutorial, a weekly email with life tips, quotes, and more. So for all of that, come join our weekly newsletter mailing list at oldpodcast.com. That's oldpodcast.com. Okay, that's going to do it for me today. Thank you so much for listening and have a great rest of your day. I will be back with you tomorrow, so I'll see you there, where your optimal life awaits.
Hello, Life Optimizer. This is Justin Malik, creator and producer of this podcast, but also Optimal Living Daily, the show where I read to you from even more blogs covering finance, productivity, minimalism, personal development, and more, from incredible bloggers like Derek Sivers, Zen Habits, Mark and Angel, The Minimalists, and all the ones you hear on this show too. So if you enjoyed today's episode and like taking amazing blogs on the go, come on over to Optimal Living Daily and subscribe to that one too. And together, we'll start optimizing your life.
You've been listening to Optimal Finance Daily. Be sure to hit the subscribe button to stay up to date on each new episode and head to oldpodcast.com. That's oldpodcast.com for a free gift as well as more actionable tips and resources to help you maximize your potential. Thanks for joining us, and remember, your optimal life awaits.